The IRS could take 40% of your life insurance payout. That sounds like fear-mongering, but it's written in the tax code. If you own the policy on your own life, the full death benefit is added to your taxable estate. And the timing is brutal. In 2026, the federal estate tax exemption is dropping from around $14 million per person to roughly $7 million. Your safe policy can suddenly become the anchor that drags your family's inheritance into a 40% federal tax bill. Stick with me because the protection strategy takes about 5 minutes to set up and can save your heirs a fortune. Why now? The Tax Cuts and Jobs Act's doubled estate tax exemption expires after 2025. In 2026, the federal exemption falls to an estimated $7 million per person. So the combined shield for married couples drops from nearly $28 million to around $14 million. That change, combined with 12 states that still collect their own estate taxes and state exemptions as low as $1 million, pulls thousands of middle-class families into estate tax territory. Add a common $500,000 life insurance policy to a home and retirement accounts, and your family can cross a threshold you never knew existed. This isn't a problem for billionaires anymore. It's a problem for policyholders. Think of your estate as the suitcase you carry through airport security. Life insurance is a heavy brick that falls into that suitcase the second you die, right before the weight check. If the suitcase crosses the airline's limit, the airline charges 40% of the overweight fee before your family can take the baggage. An irrevocable life insurance trust is a separate passenger who carries that brick for you outside the security line. Same brick, same coverage, but no overweight fee. And 1. Life insurance isn't income tax free in your estate. The death benefit usually escapes income tax, but if you own the policy, the IRS adds its full value to your taxable estate. A $750,000 term policy on top of a house and retirement accounts can push a Massachusetts family past the state's $1 million exemption and create a 6-figure estate tax bill. 2. The 2026 exemption cut is the hidden trigger. The doubled federal exemption expires at the end of 2025, so in 2026 it snaps back to roughly $7 million per person. Single parents, widows, and families with a business, a paid-off home, an IRA, and a modest life insurance policy can suddenly be standing on the wrong side of the line. 3. Fix 1. Buy new coverage inside an irrevocable life insurance trust, ILT. When the trust owns the policy, the death benefit never enters your estate, so it never triggers estate tax. Premiums can be funded with annual exclusion gifts, and the trustee controls distributions, protecting the money from lawsuits, divorce, and a young beneficiary's poor spending decisions. 4. Fix 2. If you already own a policy, learn the 3-year rule before transferring it. The IRS pulls a policy back into your estate if you die within 3 years of transferring it. People over 60 or with health problems often do better buying a new policy inside the ILT rather than moving an existing one. 5. Don't let an insurance agent design this alone. Work with an estate attorney. Agents sell products, but lawyers build legal structures. Ask about crummy powers, spendthrift provisions, and how the trust should be funded, details that decide whether your protection holds up under an audit. 6. Run a 10-minute estate audit every year. Add up your current life insurance, death benefit, real estate, retirement accounts, investments, and business value. Compare the total to your state's exemption and the federal $7 million threshold. If you're within 10% of the line, it's time to act before your heirs pay the price. Here's your one action item. Before you buy another dollar of life insurance, write down every asset you own and every death benefit you're leaving behind. If that number is close to $7 million federally or above your state's estate tax exemption, book a call with an estate attorney and mention the letters ILT. Do it while you're healthy and the rules are still clear. Want to know the next hidden tax trap in your financial plan? Watch the video on the screen right now and learn what your accountant probably isn't telling you.